Welcome to Market Overtime. I'm Oliver Renick. My guest today is one of the most sought-after financial commentators, routinely ranked as one of the top strategists on Wall Street, a trailblazing woman in finance, and a frequent guest on our own programs here on the Schwab Network. I'm talking about our very own Ann Sonders, Schwab's chief investment strategist, where she spearheads the research at the Schwab Center for Financial Research. Ann, great to have you here on Overtime for a longer chat.
Thank you. Pleasure to be here. I always love our chats, both short and long. So thanks for having me.
Yeah, we love having you almost like, I think, on a weekly basis on the network. Super helpful to always get your guys' perspective. I do want to talk a little bit today about kind of the process of how you do what you do. But let's start at the top with the market. Like, if we had to distill kind of the theme that we're in going into the second quarter of 2024, how would you describe it?
I continue to think we're seeing a roll through. As you know, Oliver, for a couple of years now, we've been talking about rolling recessions where you had pockets of weakness in the aftermath of the surge coming out of the lockdowns, part of the pandemic fueled by stimulus. And you saw those recessions not across the economy, but in areas like manufacturing and housing, a lot of consumer-oriented products. You then went into recessions in those areas, but you had the offsetting strength in the services categories. The same thing rolled through the inflation data. You saw it initially heat up on the goods side and then more recently on the services side. And now we may be starting to see some actual recoveries in area that went through their own hard landings, like housing, like manufacturing. So I continue to think we've seen a roll through, and the same thing's happening within equity markets as well.
We are recording this and talking a few days after we got a pretty surprising print on ISM manufacturing, as part of the economy that had been one of those lagging, more of a hard landing type of scenario. So is that an example of the recovery we're feeling at this moment?
It is, you're right. And the most recent ISM manufacturing did pop back above 50, and that's the first time it moved back into expansion mode, the 50 line being that demarcation between expansion and contraction since November of 2022. And the subsequent release of ISM services, although still in expansion mode, actually dipped down, I think it was to 51.8, and that was a dip that was more than expected. So we may be seeing a little bit of convergence happening in terms of goods playing some catch up finally and moving into recovery mode, and a little bit of easing of some of the heat that we had seen on the services side.
As we try and figure out, and of course many people spend a lot of time trying to target the economic outcomes, the macro shape of the market, trying to figure that all out perfectly. But then we also had this almost black swan positive event of the AI disruption over the last year. To what degree did that take eminence in the market analysis, and how do you balance kind of the macro stuff, the nuances that you get into, versus this behemoth of growth that kind of came out of nowhere?
Yeah, so I mean, AI obviously didn't come out of nowhere. It's been around actually in some form for decades, but I think it was the hype, maybe justifiably so, around ChatGPT in particular. And I think the attention when that app got to 100 million users in a very, very short period of time, less than 2 months, compared to multiple years in the case of prior innovations like that. So I think that really accelerated the hype. And I think last year's story was the more direct AI tied companies, the AI creators, the AI backbone, and that helped to drive the concentration last year, the Magnificent Seven. Now I think what has shifted as we've moved into 2024, and you've seen it with massive divergence within Magnificent Seven, with Tesla obviously not really any kind of direct play on AI other than what might be embedded in the cars, but that's the worst performing stock relative to NVIDIA's still best performing stock. And I think the AI specific story this year is more about sort of broad usage of AI. You can't get through earnings season without any company, regardless of whether they have anything to do with tech or communication services, being asked about how they're thinking about AI, how they're bringing into the mix in terms of efficiency, productivity. So I think that there's less monolithic thematic type investing happening as it relates to AI. There's more fine-tooth combing that's come into the mix.
As we do kind of get into that finer analysis around the edges of real impact, real change, have we shaken off any of the uber concentration that would have kind of changed the market risks in the broadening out of the last couple weeks, month or so? Have we grown into or maybe out of our dependency on AI, or is it still potentially a major force in the market if any of these disappointments occur?
So I think AI is still a powerful force, but to the first part of your question, we seem to have at least broken the back a bit of that concentration problem that kicked in earnest last year, particularly at the midpoint of 2023. You not only had those stocks representing a record share of the S&P, you had them representing more than all the performance. And at the same time, especially in the May-June period last year, you had a record low percentage of the S&P overall that was outperforming the index, whether it was on a prior 3-month basis or a prior 6-month basis. Things have started to shift, but as of right now, over the past year, if you go back a year, look back a year, only 11% of the index, the S&P 500 index, is outperforming the overall S&P over the past 1 year. However, if you look at just over the past 1 month, it's closer to 50% of the index that's outperforming. Also, over the past month, you've got equal weight, the S&P equal weight, outperforming to a significant degree the traditional cap-weighted S&P. So we have seen a broadening out. It's been this stealth, almost corrective phase of those concentration excesses and leadership shifts toward those more traditional cyclicals like energy and materials and financials and industrials. And that's not a bad way to correct excesses, to have it occur through a process of rotation, obviously better than the bottom falling out all at once. So I think everybody would choose this type of correction of excesses versus a swift move down across the spectrum of areas.
I do think that description, the rotation, the equal weight outperformance that's kicked in, the broadening out, the cyclical strength that's shown up very recently kind of gets us to that question of sort of how to describe where we're at. It seems like we're in a period of possible transition away from that deeply concentrated AI trade. What I am wondering is what we've talked about before, Lizanne, if we do depend more on cyclical type of companies, does that require either the economy to continue to surprise to the upside? Because if it's just AI, then the economy doesn't matter so much. It's disruption. But as we depend more on these other sectors, does that reassert the economy as the main variable again?
I think it does. And I think it does not just in terms of leadership of cyclicals, but that is the primary reason I think why that shift has occurred. We talk about things like the Mag 7 or just concentration in megacap techie related kind of names as AI driven. But I think there was more to the story than just that. I think those types of stocks, not specifically those 7 stocks, but that sort of concentration, that bias in performance by some of those mega cap tech and tech related names has been a force in the market really since the early part of the pandemic. And I think the reason for that is different reasons at different times. They've actually represented defense. Not typically defensive areas like utilities or consumer staples. That's what we typically think of as defensive. But I think early in the pandemic, they represented defensive kind of names because they represented the ecosystem in which we were all living when the ecosystem we were used to, day-to-day life, was shut down. Fast forward to the more recent period, like last year, that concentration, the Magnificent Seven, really kicked into high gear around March of last year when we were in the throes of what we now think of as the mini banking crisis. And I think at that point, what they represented was the defensiveness associated with big liquid companies that had strong balance sheets, that didn't need the banking system, that had visibility in terms of earnings. And so I think there have been different reasons, but that's what they represented. Now we're in an environment where there's less of a focus on being defensive, however you define it, and with stronger growth, which has changed the expectations around Fed policy, that has shifted attention and leadership to those more classic cyclicals where you have that leverage to what we've seen, which is a pickup in economic growth. But it could be fleeting, of course, if that improvement in economic growth doesn't have sustainability.
Absolutely, and that's kind of the more the up to speed, those last couple items there about the strength of the economy, the kind of rotation. That's the more recent action. I do want to come back to your point though about the tech as safety. I think that's so important, especially in a conversation that is, thinking about kind of big ideas. The idea of tech acting as safety. I mean, as you mentioned, maybe not like a utility, but in some ways, maybe these could be our kind of new telecom utility style. A lot of them have recurring sales, they have membership prices, and to your point about liquidity, Apple just has tons of cash. And there were even moments that I noticed last couple months where when Nvidia stopped working, Apple was almost trading like bonds. I mean, do you feel that we really kind of have changed sort of the functionality of some of these big cap as their own asset class?
Yes, but not in a monolithic way, because I'm glad, and as you know, Oliver, I don't cover individual stocks at all.
Yeah.
So when I talk about individual stocks, it's in the context of naming names within the Mag 7 that might be outperforming or underperforming, but it doesn't come with any endorsement on my part. But it's interesting that you mention Apple, because there's a lot of chatter this year about maybe changing the moniker from Magnificent 7 to Fab 4 or Fab 5, because you've had the dramatic underperformance on the part of Tesla, but also pretty significant underperformance on the part of Apple. Mm-hmm. And I think that's more about the sort of elimination of the monolithic lens that we're looking at things through. And it's coming back to a point where fundamentals really matter. Yes, you're absolutely right. And it's not just tech, but these mega cap names that actually do have strong earnings profiles and have the strength and balance sheet that have, in many cases, these are companies that in this higher interest rate environment and maybe higher for longer, given concerns about stickiness and inflation, many of these companies are actually earning more interest on their cash than they're paying interest on debt. We don't have to worry about the rollover problem that's plaguing a lot of the smaller cap companies that funded themselves in a ZERP kind of environment and now are facing higher interest costs. So I think that's been the primary differentiation, is these incredibly cash-rich companies that they have sort of a bankable earnings stream in an otherwise uncertain backdrop from an interest rate perspective, from an economic growth perspective. But that doesn't mean that in perpetuity, if they're lumped into that group, that they can just sort of ride the wave. At some point, if you have a real bad, string of earnings misses, you're going to get punished. And I think that dispersion and fundamentals reconnecting to prices, all else equal, I think that's a good thing. I think it's a benefit to active relative to passive, not over passive, but more of a level playing field. And I think it's a better environment for stock pickers out there.
It helps certainly also for the passive investors too, when the big companies that make up a lot of the index have those strong cash flow characteristics. I love the point behind big cash piles now generating income for you in a higher rate world. So if you don't have onerous debt, then you've there got a free cash flow company just kind of sitting as an almost safety trade. Yeah. How much of this does relate to bonds, Lizanne? How much does that kind of safety aspect to some degree, that kind of factor some of these big caps have exhibited, depend on a market where investors are a little wary on bonds still, inflation, rates for longer? Does that contribute to this?
So it does, but I think there's been an important shift, kind of a nuanced shift that has occurred since last summer, the point at which, using the 10-year as an example or a proxy for the longer maturity bond market, when you went from under 4% to 5% in pretty rapid fashion from that late July to late October period, that was sort of a shoot everything, ask questions later kind of backdrop, because we saw a correction overall in the S&P, in the Nasdaq, the hits were even greater to many of those mega cap names, just because of how rapid that move up in yields. And then in turn, when yields plunged, they started the plunge at the end of October. Everything got a lift as a result of that. But the recent reacceleration in yields, you've seen just a bit more of a shift in terms of where the hits are greater. And the move up off that 3.8 or 3.9 recent low was to the greater detriment down the capitalization spectrum. It really hurt small caps, which had tried to, find their legs, particularly in the first couple of months off the rally that started in late October. Small caps in general doing well, but then there started to be this bifurcation and more of an analysis of, are you a zombie company? Are you a profitable company? Where actually the impact of higher yields short term will be felt greatest also in the short term. So you saw more resilience up the cap spectrum, but you saw more hits down the cap spectrum into those more vulnerable companies. And I continue to think that is going to be what happens. I don't think it's, baby out with the bathwater, yields go up, all stocks sell off. I think the healthy, well-capitalized companies that have ample interest coverage will be more resilient if yields continue to move up. But you've got to be really careful of those non-profitable and in particular zombie companies that don't have the cash flows even to pay the interest on their debt and have that rollover risk.
Well, I might have mentioned this to you before in our daily chats, Lizanne, but kind of a side point I wanted to get your thought on real fast. It's a little bit of a crackpot theory, but when we think about like stocks on the quality spectrum, and your whole case has basically been on quality, and that call has nailed it. I mean, over the last 2 years, we'd be better off in quality factors above momentum, above the market itself, because they lost less on the way down, and they almost did as well as some of the momentum stuff on the way up. But to that point, if the stock market now is basically funneling up in terms of quality, and then we have these crypto markets where there's all these altcoins that are like literally jokes, what's the role of a super low quality equity anymore? Like, does it have a role? Because if I want to go low quality, I go to crypto markets. Is that taking anything away from the small cap?
Well, I agree with you that that's the ultimate, low quality segment of the market. Oliver, there are times, leaving crypto aside, and yeah, there is money that will chase low quality either because there's momentum there or it's, meme type stuff. But there are vehicles for that now, whether it's crypto, whether it's meme stocks. Leaving that aside, there are times when it makes sense to go down the quality spectrum. In terms of areas where, say, a company had, a decent earnings profile, then went through an economic downturn, lost earnings, had to kind of lever up. But then as you see an acceleration in economic growth, maybe courtesy of the Fed lowering interest rates, you've got that leverage to the upside. You've got that profitability leverage. You've got the improvement in terms of the outlook associated with things like interest coverage. I just don't think we're there yet. And I'm glad you mentioned, how consistent quality has been outperforming. There's lots of individual factors that sort of roll up into that quality bucket or that quality umbrella. But importantly, those quality type factors have led pretty much in every sector. So it doesn't, focusing on strong free cash flow and interest coverage and health of balance sheet and low debt, all of those things, might have allowed you to appropriately sort of snuggle up the cap spectrum into those mega cap types of names. But that's not the only place where quality worked in terms of driving you to a certain subset of stocks. And like I said, that quality focus has worked pretty much across all 11 sectors, even in areas that might be considered non-growth, non-momentum, more value-oriented. So that's an important thing to understand about factor analysis.
Okay, love that. It's very cross-sectional where it shows up within sectors, within subgroups. And the market has at least some efficiencies that it seems like it has mined out over the last couple of years. So maybe there's some functionality of higher for longer. It sounds like if you want to make a big bet on a Fed deep cutting cycle, the low quality, small caps is kind of a proxy for that low quality if you're forced to do it on an index level, is basically the way to express that trade without having to like short something. Just avoid it basically and stay in the higher quality.
Yeah. So again, there are opportunities to go down the quality spectrum, but it usually occurs in the throes of a recession when the Fed is in aggressive easing mode,
Right.
and you establish that leverage back on the upside as you sort of come through that inflection point. Again, I'm not sure that describes the current environment. Yes, we have had this reacceleration in growth, but it's not because we were in recession type conditions broadly for the economy, bringing the Fed in with much easier policy. But I also like the point you made, Oliver, about this higher for longer environment. I think there, as much as sort of we think the market is obsessed with when the Fed starts cutting and how aggressively they cut. You and I talked about it quite a bit back in January when the expectation was for a March start and 6 or 7 cuts. We were very vocal about saying the market is way over its skis here. And frankly, if that's what you think the support is for the market and that's what you're wishing for, be really careful, because a Fed that does a 180 in such short order from the most aggressive tightening cycle and then starts to cut as aggressively almost as they did on the upside, the background conditions supporting that would be pretty ugly relative to what was actually happening in January. So I think this environment of higher for longer, especially because we've had higher real rates, as the Fed has been in pause mode and not perfectly linear, but as we continue this path in disinflation, real rates have gone up, but not to the detriment of the economy, at least not yet. And that's why the market has been resilient.
I really like that too. It's kind of a refresher, reminder for those who haven't been following your coverage. What I like about the way you approach the market is it's agnostic the same way we are when we think about like politics, unless there's real bills changing sectors, et cetera. And you're able to see inaccuracies in the market without developing sort of extreme cases. Because in the last 8 months or 6 months rather, a lot of folks will say, okay, if you think the Fed's not going to cut, which you guys were right on, that they weren't going to do that. A lot of people turn that into kind of this deep bear case that, okay, everything depends on this, but that is not the case. And it sounds like today you would argue the quality trade, you don't have to be fearful of a Fed that's not going to cut. It might be for good reason that is essentially the higher for longer trade. What would suggest to you, Lizanne, that this regime is breaking? Like, what would be a major red flag that this type of investing regime is changing?
So I think probably a worst case scenario from where we sit right now for the market in terms of market behavior and performance and leadership, but also in terms of what that would suggest about Fed policy, would be if economic growth rolls over significantly from here, but you don't get the commensurate rolling over in inflation. And in particular, if inflation continues to accelerate, yet growth rolls over, whether you call that stagflation to bring back a 70s era word or reverse Goldilocks, as we've been kind of joking about, that I think would be worst case scenario. It may be supportive of rate cuts, but then it would be the Fed cutting rates to combat the economy without being able to declare victory on inflation having gotten to their target. Now, I think base case and what has supported the market has been economic growth that hangs in there and disinflation persists. We could have a scenario where inflation doesn't roll back over. It turns out that the pickup that we've seen recently in inflation and things like the 3-month annualized change is not just seasonal, but has legs behind it. I think the market can still be okay if growth hangs in there. Obviously, the other end of the also worst case scenario, maybe also weak for the equity market, would be a plunge in both, a big move into recession territory and a move from disinflation into deflation, financial crisis kind of mode. I don't think that's really anything resembling the base case. It's certainly not our base case, but it's sort of, you can go to two extremes on the spectrum and it represents risk for the market. And in part, that's because sentiment has gotten frothy. That's never a market timing indicator with any kind of precision, but it represents a backdrop that you need to be mindful of to the extent you think about negative catalysts. I think the downside could be maybe greater because sentiment is so one-sided.
That's where I think the last couple of weeks has gotten interesting, because the markets really hadn't been paying attention to bonds for months. And it seemed like maybe with valuations getting to where they are now, that we're starting to pay a little bit more attention. The more expensive you get, not a timing tool, but does kind of create more openings for imperfections to emerge. So the two kind of that you highlight there, one being the major breakdown in the economy, the kind of a lower risk, but deflation and major recession indicators. The other one being the kind of non-Goldilocks. I got a phrase for you, Liz Ann. I'm going with purgatory. Right? It's like maybe not stagflation, but it's kind of that inverse Goldilocks. It's purgatory. You're stuck, but it's not as good as Goldilocks.
You're stuck. And it does put, the Fed in somewhat of a pickle jar at that point, because what they really want to avoid in this environment is a significant reacceleration in inflation that then becomes something that they have much more difficulty trying to combat on the rate side of things, especially if simultaneous to that, they're trying to combat a weaker economy. Again, not base case, but it's always important to think about where the tail risks are.
Fair to say then, I guess, in about 2 out of 3 of the scenarios we talked about, the status quo scenario, the kind of purgatory scenario, and then like the deeper classical recession. Sounds like quality is basically the way to go. It should work in 2 out of 3 of those. And then if the worst one happens, then okay, maybe you kind of get a more traditional flush out and you go for the small caps on the other side.
Well, I would say there is one other scenario. I don't think it's a highly likely one, but this is one that might allow for lower quality to outperform, which would be an acceleration in economic growth at the same time persistence in disinflation. And in short order, you get down to the Fed's target without having any sacrifice on the part of the economy. Maybe that's the too good to be true scenario, but let's put it out there. But that's the rocket ship scenario. The no landing, it would probably maybe mean a little bit longer before the Fed can move, but they won't be, they wouldn't be constrained by inflation as a reason not to move. And they could hang their hat on, well, real rates have gone up too much, and we don't want to, on a forward-looking basis, damage the economy. And now that inflation is at our target, we can start cutting. That may be a low likelihood scenario, but that would, I think, certainly be the scenario where you would probably see significant outperformance down the cap spectrum into lower quality areas.
Great stuff. Love that kind of classification of the 4 possible scenarios there. It's super helpful. Liz Ann, I want to ask you about kind of the way you handle information. I mean, we have so much information today. You have all kinds of charts. You're as active as I am on Twitter, more with charts and data. Obviously, you're trying to balance that with everything else. Like, what's the tip for investors or traders? Like, how do you synthesize? What's your process like?
Well, Oliver, some of it is 38 years of practice doing this. So I've always been the drink from the fire hose of information type of person, but it's as much an art as it is a science to know what to filter out, what matters, what doesn't, what's noise, what isn't, but also be very flexible in understanding that cycles are always different. The old adage around this time is different is a dangerous line. I've never agreed with that. I think this time is always different as it relates to market cycles. So having that flexibility, not being dogmatic, trying to be very fact-based and very data-based, as opposed to trying to make a name for myself with bombastic forecasts and year-end price targets and, timing 10% moves on the upside or the downside. I just don't think that that's of value to our bailiwick and our client base of almost $9 trillion, which is individual investors. So I think it's something that's honed over time. I was asked recently on a webcast that I did, it was a bunch of people on it, and there was a question asked of everybody, if you thought of yourself as having a superpower, what would it be? And I said, well, maybe my superpower, if you can call it that, is being a chronic insomniac. And that just means that I have more time in the 24-hour day, a lot of which is spent in the middle of the night, reading in an environment where it's dark and I don't have any other distractions. But it's just something you figure out. And our colleague Kevin Gordon, who works with me on the research side, he and Adrian Beata, who's been with me for 25 years almost, they're chart mavens.
Yeah,
if they ever left and said, okay, you're on your own creating all these charts, my Twitter feed would be a lot more boring than it is. So I have a little team, but they're a really powerful team. So in terms of generating those visuals and that constant flow of information and reaction to economic reports as they come in real time, I give a lot of credit to my team.
And that shows up because it's always very clear where the original data is from. That's what I like about it. You guys are oftentimes building these things on your own. Of course, where indexes are available, et cetera. But you guys have been a great contributing force on the Schwab Network as well. Thanks for the long chat, Liz Ann. Appreciate your time.
My pleasure.
Great to
Great to be
again.
here. Thanks.
Yep, and we'll see you on the network, of course. Liz Ann Sonders, the Chief Investment Strategist at Charles Schwab. Thanks for tuning in to Market Overtime. You can find the rest of these videos on schwabnetwork.com. I'm Oliver Renick. Appreciate you joining.